Good morning, everyone. Today, I introduce one of the most fundamental concepts in economics: equilibrium in a free market economy. This is the point where the forces of supply and demand meet and balance each other. Understanding equilibrium is crucial because it tells us how prices and quantities of goods are determined in the real world. Let's start with the demand curve. Demand represents the quantity of a good that consumers are willing and able to buy at different prices. Generally, as prices fall, the quantity demanded increases. That's why the demand curve slopes downward. Now let's consider supply. Supply represents the quantity of a good that producers are willing and able to sell at different prices. As prices rise, producing that good becomes more profitable, so suppliers are willing to produce more. That's why the supply curve slopes upward. Equilibrium occurs at the point where the supply and demand curves intersect, the speaker explained informatively. At this price level, called the equilibrium price, the amount that consumers want to buy is exactly equal to the amount that producers want to sell. The corresponding quantity is the equilibrium quantity. If the market price is set above equilibrium, producers supply more than consumers are willing to buy. This creates a surplus. Sellers then lower prices to clear the excess stock. On the other hand, if the price is set below equilibrium, consumers demand more than producers are willing to supply, creating a shortage. Competition among buyers drives the price upward. In both cases, the market naturally pushes itself back toward equilibrium, unless there's government intervention, external shocks, or other market distortions. Think about farmers' markets. If the price of tomatoes is too high, customers buy fewer, and farmers are left with unsold produce. If the price is too low, the tomatoes sell out quickly, leaving some customers without. Over time, both sellers and buyers adjust until they reach a balance, equilibrium. To summarize, equilibrium in a free market economy is the state where supply equals demand, resulting in a stable price and quantity. It's the natural balancing point of the market, he concluded. In our next session, we'll look at how shifts in demand and supply, like changes in income, technology, or resource costs, affect equilibrium, the professor concluded.